Excellent. Hey, well, good afternoon and welcome to our tax planning webinar with myself, Kyle Johnson, owner and senior wealth advisor of Link Wealth Strategies, and Bradley Hamill, CPA and owner of Bradley Hamill CPA firm. Link Wealth Strategies has the pleasure of partnering with great CPAs like Bradley Hamill. We work as the retirement planning and wealth management arm of great CPAs and enrolled agents like he is. In the tax industry, and I'm sure Brad would corroborate this, that tax preparation, while it is a commodity, we specialize in tax planning, helping people to think strategically through their tax return and find strategies specialized to them to help them make the most of their investments and their tax return. So I'm glad to have Brad with us. Brad has been a CPA since 1991, and he serves over 950 tax clients annually. In today's webinar, what we're going to do is take some of the key questions that he and I have both seen in our firms, and while working with some of our combined clients, we're going to only be able to do kind of a cursory overview of some of these questions. So I do apologize in advance if we do not scratch the itch that you might have. A lot of times, as Brad has mentioned to me, a tax question, the answer he often gives is it depends. So it depends on your unique circumstances as to how the answer to some of these tax planning strategies, ideas, and questions may apply to you personally, which we'll give you our contact information at the end of this webinar so that you can get in touch with our offices and schedule some time to talk about your situation. So thanks for being with us, Brad.
You're welcome. Thank you.
Well, to try to make the most of our time, we'll get right into the first question that we agreed is one of the top questions that's asked or needs to be understood by your tax planning clients or retirement planning clients. What is a required minimum distribution, often referred to as an RMD, and when do I have to take it?
Very good question. And yes, Kyle, that is a common question I get from my clients, and I'm sure you do too. Required minimum distribution is a requirement from the IRS that your qualified plan money, this is any money that's never been taxed yet, like your rollover IRA, your regular traditional IRA, your 401k, anything like that that you've put away into retirement and deferred the tax on it until retirement. That's what we're talking about, is that money that's never been taxed. And for a long time, you were required to take a minimum distribution at age 70 and a half. And how that's calculated is the IRS has a standard life expectancy table, and wherever you have your IRA, you're an IRA administrator, then calculates a value on December 31st of the year right before you're going to turn that 70 and a half. And then based on that number, they simply divide that by your life expectancy, and that result is what you have to take out that year. And for example, the average 71-year-old person in America lives 18 more years. And so you take your total balance divided by 18, and that's the number. You have all that year to take it out. And you can actually, the very first year you reach that age, you can delay it until the following year and take it out by the following April. But the drawback to that is then you have to take two that second year. So that could put you in a higher tax bracket. So when you get that first letter, it's good to go over that with your accountant or financial planner and talk about your tax brackets and where it is and when we need to turn those on. And I mentioned 70 and a half. It was that age for quite a while. And with the new tax laws coming along here lately, now we've got 4 ages to worry about: 70 and a half, 72, 73, and 75. And it all depends on what year you were born. briefly, July 149 to all of 1950, you can take it out. You start at 72. From 51 to 59, your birth year, you start at 73. And if you were born after 1960, you start at 75. Now, don't worry about that. Again, like I said earlier, your plan administrator is required by law to communicate all this information to you. So typically in January of the year you reach your RMD age, they're going to send you a letter, and be sure and read that letter because it's very important. Because if you don't take out your RMD amount, it used to be you had to pay a 50% penalty on what you did not take out. Now that's down to ranges from 10 to 25%, but it's still a penalty. And we certainly want you to avoid that if you can. So RMD, when you hear that, required minimum distribution, typically starts when you're over 70, and it's a required minimum amount you have to take out of your IRA every year as long as you're alive.
Excellent. Hey, thank you for that information. And maybe just a little bit of clarification on the investment side of things. When Brad refers to plan administrator, it's usually the investment firm that you've hold your investments with. In our case, it's Avantax, and our clearing firm is National Financial Services. So our clients will receive a letter, some kind of communication the year before their RMD age. And we certainly work hand in hand with folks to set up those distributions to go out annually and have the appropriate tax withholding, as advised by Brad in this situation, withheld before it arrives in your bank account. So thank you, Brad. Question number 2 that we have here is regarding step up in basis. What exactly is step up in basis, and how can it help my family?
That's also a very good question, and it's really a wonderful thing under the tax law in America. I'll give you an example. You have assets that you have acquired during your lifetime. You paid a certain amount for those assets, like your house that you live in, your car, some land you own, some farmland, or any other asset. If you've just had cash and you invested in the stock market, for example, and it has grown in value, all of those assets, upon your death, we do an appraisal of all of those, and your beneficiaries can inherit those, and their value for tax purposes is that appraised value on your date of death. So just give you an example. Let's say you've paid $100,000 for a bunch of assets that you own, all different flavors and varieties, and upon your death, they're worth $1 million. And upon your death, your will or trust gives all that to your kids. Your kids can sell all of those assets for $1 million tax-free. That's the step up we're talking about. Whatever you paid for it no longer applies. Your beneficiaries get to step up the value to the market value on the date of death. And if it happens before death, if you transfer assets before death, that doesn't apply. This is only upon death that you get that step up. And the beautiful thing now in America is that you can inherit almost $13 million tax-free. So, grandma and grandpa's farm that's worth $500,000, that can all go to the kids tax-free. I mean, it used to be only 600,000, now it's 13 million. So this is a wonderful law. It allows a great transfer of wealth from one generation to another without having to incur a 30 or 40% tax hit on that. So anything under 13 million, there's no longer any inheritance tax in the United States, and there is no inheritance tax in Kansas. So both federal and state, tax-free up to 13 million.
Excellent. And that's a great segue into this next question. While we talk about step up in basis on what's often considered non-qualified assets, mutual funds and land of the sorts, this one is in regards to IRAs, how that might be different. So what is the withdrawal requirement if I inherit an IRA? How long does the IRS give me to withdraw and pay taxes on the inherited account?
You're right, Kyle. That is a good segue into this question, because all of those assets I talked about on the last question are all encompassing except for retirement plan assets. So like an IRA, a 401k, a rollover, anything like that. Those assets, when they transfer to a beneficiary, tax will need to be paid on that when the beneficiary takes it out of that account. So the step-up rules do not apply to qualified plan money. So if you are a spouse and your spouse passes away, that you inherit that qualified money and just put it right in your own inherited IRA account, and you have to withdraw under the RMD rules that we talked about earlier, and everything stays the same. It just all becomes your money in your inherited IRA. But if you're a non-spouse, if you're a child or a cousin or anybody else it may be, then you have 10 years to clear out that account. And there are a few minor exceptions, but that's the broad brush stroke of this, is you have a 10-year requirement to take it out. Now, if the person that passed away was already taking their RMDs, their required minimum distribution, then the current regulations are that you have to continue those RMD distributions during that 10 years. And then in the 10th year, you have whatever's left, you have to take it all out. You can take it out faster if you want. You can take it all out the first year if you want, but in 10 years, that account has to be empty. If the person that passed away was not taking the required minimum distributions, generally they're under age 70, then you have 10 years to clean it out just like it before, but there is no requirement right now that you take a little bit out every year for 10 years. You do it all in the 10th year, you meet the IRS rules and regulations, and you're fine.
Excellent. Hey, thank you for that. You did touch briefly on the 10-year strategy, and I'm going to hold this over for a minute because in a couple questions here, we'll talk about tax efficient withdrawal strategies. And there being different amounts that you can withdraw over the course of those 10 years, it might really make a difference to meet with a tax planner based on your current income to come up with the most efficient strategy of withdrawing those inherited IRAs. So we'll move on to the next one here. Question number 4 that we often hear about in both of our offices: is there a more tax efficient way to donate money? And what is a qualified charitable distribution, also often called a QCD, and how does it work?
Thank you, Kyle. Again, that's a great question. This has been an interesting transition. Everything Congress and the IRS does is interesting to me, the way it all gets enacted. But the first qualified charitable distribution was several years ago, and they brought it into the law like on December 26th and gave everybody 5 days to get it done. And that was kind of bizarre. And then it went on like that for a year or two. Now they finally made it permanent. And so what a qualified charitable distribution is you can take money directly from your qualified money, your IRA, 401k, and donate it directly to a charity, and then you don't have to pay tax on that withdrawal. It's wonderful. So you just tell your plan administrator to send that money directly to your charity of choice, and then I don't have to put that money on your tax return and make you pay tax on it and then try to deduct it on your itemized deductions. Now, I mentioned itemized deductions, so let's briefly hit that to tell you why this is so good. Under the tax law, you all know about deductions. You've heard the word deductions, itemized or standard or short form or long form. Deductions under our tax law are 4 big components: medical expenses, taxes you pay on your house and cars, mortgage interest you pay on your mortgage, and the 4th is charitable contributions. And in 2019, they increased the standard deduction significantly. And right now for 2023, if you're a married couple and over 65, you get $30,700 automatically as a standard deduction. So basically the first $30,700 of your income is tax-free. So back to this qualified charitable distribution, normally before this law, you would take money out of your IRA, put it in your bank, write a check to the charity. So you pay tax on the money and then you donate, say $10,000, to a church or charity, but the government's already going to give you a $30,000 deduction for all of those 4 items, including charity. So you really didn't get any tax benefit by doing that. Now with the qualified charitable distribution, or QCD, you get the best of both worlds. You don't pay tax on the front side when it comes out, and you still get the full $30,700 deduction as a standard deduction. So it's wonderful. Now, if all of your deductions are greater than $30,700, that's fine. We take the larger number, and so that law still is in place, just like it's always been. But the QCD is wonderful because you pay no tax on it coming out of the retirement plan, and you still get the full standard deduction on the deduction schedules. And so everybody wins on that. And this is kind of minor, but if you are one of those that love to give to 20 different or 100 different charities, $100 a month, you're probably going to have difficulty talking to your plan administrator and having them send $100 to 20 different charities every month. That they're not accountants. They're just doing this because the law requires them to do it. So they all have different plans, and they're all getting more efficient every day. But generally, usually it's a once or twice a year thing where you send the money to a charity. Now, earlier I mentioned required minimum distributions, and that those forever and ever started at age 70 and a half, and now it can be 72, 3, or 5. And so originally the qualified charitable distribution rule and the RMD rule were married together and together. When the law changed to allow longer for you to start taking RMDs, the QCD law did not change. So at 70 and a half, you can start making qualified charitable distributions, even though you're not required to do RMDs yet. And that will give you the tax benefits that I talked about. Once you start doing your RMDs, these charitable distributions satisfy your RMD requirement. So if you get that letter and it says you need to take 30,000 out of your IRA this year for required minimum distribution, you can say, send that directly to a charity of my choice, and then you've met your RMD requirement. You won't pay a penalty on that. The charity benefits, you benefit because you don't pay tax on that at all, and you still get the $30,000 tax-free standard deduction on the deduction side. So this is really a good law, but you do need to communicate this information to your tax person. Right now, since this law is still fairly new, there is no mandatory prescribed way for these distributions to be communicated to your tax person. You will get a letter from your IRA administrator telling you what they did. Based on your directions, they sent the money here and there. And those letters, I need to see those, or your tax person needs to see them when they do your taxes, because there's no special codes on your tax forms to let us know that without you telling us. I'm hoping that someday there will be some special codes to let us know that, but right now there's not. So if you do that, keep your receipts, keep your records, communicate it, and have it taken care of when you do your taxes. It's a win-win for everybody. Starts at age 70 and a half, goes on for as long as you want to. Once you hit RMD age, these distributions to a charity will satisfy your RMD requirement. And again, everybody wins. So very good law. I'm glad, and they've made it permanent now. And so that's a good thing that we can now actually plan on it, and makes it very well. I have several clients doing this every year. It's a wonderful law.
Interesting, you saying that they've made something permanent. That's excellent. So
yes, finally.
Administratively, from our end as a financial planning firm, oftentimes what we've had, Brad, is folks will say they have a desire to give to a nonprofit, or maybe they've done that to date with money out of their savings or checking account, and we explain the qualified charitable distribution, and they'll merely put in a request with our office manager, Casey Frisbee, and Casey will send that money directly to the nonprofit organization. And then we encourage them to go to the office staff or administrator of that nonprofit and get a receipt, like you mentioned, so they can tie it up with the tax return as they work with you.
Yep.
So, well,
yeah,
this next
as this, now that the law is permanent and as people like Kyle and other plan administrators realize this is going to be an ongoing thing, they will put programs in place to make this easier and make it where they can be more flexible. But yeah, initially it's typically better if you do it in large sums, but work with your plan administrator, whatever system they have, work within that. It works very well. Everybody wins.
Excellent. Thank you for that. These next two questions were great on time, are perfect illustration of why we work together and why our firm exists to work with tax firms like yours. The question is, what is a tax efficient withdrawal strategy and how can it help me in my retirement?
That is another common question and a great question. Under the tax code that we live under, you have layers of income taxed at different percentages. The higher your income, the bigger percentage your tax bracket is. We all have heard about tax brackets. And so as a married couple, the first $22,000 of taxable income, I make sure that's taxable income. So for example, if you make $50,000 and $30,000 of it's tax-free, like I mentioned earlier, because of the standard deduction, that leaves you $20,000 of taxable income. That $22,000 technically is taxed at 10%. From 22 to 89, it's taxed at 12%. After 89,000, the next bracket, which is $100,000 wide, is taxed at 22%. So when we talk about tax efficient strategy, what we're trying to do is I don't want you to pay $1 more tax than you have to. So if you're thinking of taking some money out or doing some withdrawals from your IRAs, we want to try to keep you in the lowest tax bracket possible. So if you're getting close to the top of the 12% bracket, we may encourage you to stop if you can withdrawing and stay at that $89,000 cap so that you only experience the 12% rate and not spill into the 22% rate. But while I'm talking about the brackets, one thing I do want to make clear that may be confusing to people. Just because you have a dollar that goes into the next tax bracket doesn't mean you fall off the cliff and you pay 22% on every dollar of income you have. Doesn't work that way. You still only pay 10% on the first 22,000, 12% on 22 to 89, and then only the few dollars in the next bracket do you pay 22% tax on. But so we want to keep it down as much as we can, and that's a big jump. To go from 12 to 22, that's a 10% jump. The next bracket after that's only 24%, so it's only 2%. So it's not a huge jump, but certainly we want to keep you, if you can afford it and live on 90,000 a year, then keeping you down in that 12% bracket is really the right way to go. So that's what we're talking about on tax efficient withdrawals. That's one of the main strategies, is watch your tax brackets, make sure we don't accidentally put a bunch of money in the next bracket and have a bigger tax bite than you were thinking about. So just anytime you're going to make a withdrawal from a retirement plan that changes your taxable situation, it's good to talk to your tax man in advance and find out exactly what it's going to cost, and so that you can plan for that. In fact, you can, as that withdrawal comes out, we can encourage you to have federal and state taxes withheld from that right up front, and then your tax is already covered on that. You still have to turn it in to me, and we do the calculation to make sure it was the right amount. But at least the tax burden is taken care of on withdrawals, just like it did all those years when you're drawing a weekly paycheck, take taxes out of every check. We do the same thing here. Any money that you're taking out from a non-taxed area to a taxable area, I would encourage you to always have a certain amount of federal and state tax withheld on that, so that that tax burden is taken care of. That's
Yeah.
the easiest way to handle the tax code on that. There's 2 or 3 other ways, but that's the easiest way. So that would be it. Tax bracket creep is what we want to keep you away from.
Excellent. Hey, thank you for that, Brad. You know, one example, this morning I received an email from one of our great clients, and his wife retired this year from teaching, and so she's going to start a pension, and they have decided they'd like to buy a Mustang at some point this year and are wondering what accounts they should take money out of in order to pay cash for the Mustang, whether they should pay part of it this year and part of it after January 1, so it spreads out into 2 tax years, that sort of thing. So certainly that's something that we pass on to our CPA partners to determine what is the most efficient way for them and what accounts are best for them to take out of. So,
and something related to this that I would probably ought to touch on, it's not specifically in the question, but it's part of it. Under our tax law, if the only income you have is Social Security, it's 100% tax-free. But if you have other income, like a pension of some kind, there's a formula we go through that some of your Social Security starts to become taxable. If your income is high enough, then up to 80% of it's taxable. And so that's another important consideration to watch. I have some clients that, you know, they're cruising along with a little pension and Social Security, and they're doing fine and have enough money to live on, and they're not hardly paying any tax at all on their Social Security. And then, like Kyle said, someone wants to buy a Mustang. In my case, I'd go buy a truck. But, you know, you take a little extra money out and buy this special thing you've been wanting to do, and all of a sudden that money is taxable. A bigger chunk of your Social Security is taxable, and possibly even state income tax on some of that's taxable. So there could be some major hits on some of that when you have a unexpected withdrawal like that, or a planned withdrawal, but don't plan the taxes. So Social Security tax, or the tax on your Social Security income, is a big deal to calculate. And just that's all part of the calculation that we do when we come up with a tax efficient strategy for you. And so be sure and watch that Social Security taxability part.
great. Hey, thank you for adding that. It can be pretty complex, for sure. Hey, we're doing great on time. One final question that we have here. Question number 6, what is a Roth conversion strategy, and why would it be beneficial to a client with an IRA?
Great question. Let's define what a Roth is, first of all, just in case some of you may not know what that is. Many, many years ago, you know, the IRA law was passed. You can have a traditional IRA. You put money into that account, you tax deduct it the year you put it in the account, and so it saves you money immediately. And then all the earnings on that account are tax deferred. Those are the type of accounts we've been talking about all morning. The earnings on that is deferred until someday when you take the money out of that account. Then, since you deducted all the money going in and all the earnings on the money has never been taxed, all of the money, all withdrawals from a traditional IRA are taxable, and they always will be. There's no way out of that. Several years ago, they came up with this Roth IRA concept. And the law is on that is, this is an IRA as well, but under a Roth rules, when you put money into that Roth account, you don't deduct it on your taxes that year. But all the earnings on that account are no longer just tax deferred, they are tax free forever. So you put $5,000 a year in a Roth for 20 years, and then it grows to a much bigger amount. All that interest on that account, when you pull it out, is tax-free. So it's a wonderful investment. So the Roth account is wonderful. The younger you are when you start retirement saving, the better the Roth is for you, because the power of compound interest on your invested money is huge. Sometimes your interest alone could be double or triple what you put into the account. And converting all of that income to tax-free is wonderful. And so that's the idea of a Roth. Traditional IRA, deduction, but taxable someday. Roth IRA, no deduction, but tax-free when you take it out. So we have these two accounts out there, traditional and Roth type IRA accounts. And let's say you're my age and you didn't have the opportunity to do a Roth when you were younger. And so you're ready to go through retirement, and then what do? Well, you can, but just for round numbers, let's say you have $400,000 in your IRA account and you convert it to a Roth. What does that mean? Well, then you pay tax on that $400,000 today, so that value goes to $300,000, roughly 25%. It's a nice round number. Plus, I can do the math in my head. So 400,000 times 25% is 100,000. You end up with 300,000 in the account, and then it grows in 10 years. Let's say you're earning 7.2% on the money. In 10 years, it's going to double from 300,000 to 600,000. So you're, say, 65 when you do this. At 75, you have 600,000. At 85, you have 1.2 million. And that entire 1.2 million can go to your beneficiaries completely tax-free. So it's a wonderful opportunity to do this. You have to have the big bite up front, because every time you convert anything, it's taxable, but then all the earnings on that Roth money from that point on is all tax-free to you and your beneficiaries. If say in 10 years you needed some money and took money out of that Roth, it's tax-free. The money you put in plus the earnings, you take it out, all tax-free. And I gave an example of 400,000 and converting the whole thing. You don't have to do that. You can convert just 10,000 or 20,000 or whatever you want to do. And that's part of that tax-efficient retirement or withdrawal strategy in retirement planning we talked about in question 5. We might want to do some Roth conversions a little bit every year for, say, 5 years to keep you down in that 12% bracket, so that all of this money you're only paying 12% on, but then upon distribution to your children, when they're in their 50s making great money, they're at a 30% bracket, they get all that money tax-free. So you've basically satisfied the tax on that money and transferred it to a next generation, all tax-free. So it can be a good strategy to have, and done in cooperation with your tax planner and your financial planner. Then we can keep you out of a large tax bite on that, and it really is a great thing. And in the investment world, as we all know, the market goes up and down. There's no way to get around it. We're going to have a recession at some point. The market always pulls back and whatever. So if you're cruising along with a nice IRA portfolio, and we have one of those down markets, say it's down 10% 1 year, that would be a great time to convert a bunch of that to a Roth, because we in the investment business can't guarantee it, but we know the market's going to come back. It always has for 100 years. It's going to keep coming back someday. So now you have that on paper, it's shrunk a little in value, but if you convert it to a Roth and put it in the same exact investments if you want to, all that growth on that 10% recovery that you're going to get is all tax-free. And then it keeps growing after that, tax-free. So in a down market, it's a perfect time to do some Roth conversions. There's never a bad time, because it works well, but certainly in a down market, it's a good time. The other nice thing about a Roth account, earlier on question 1, we talked about required minimum distributions. You reach age 70, roughly, you have to take money out. You don't have to do that in Roth. You don't have to worry about it. If you don't need the money, just leave it there. And it just continues to grow and compound and grow and compound. And the power of compound interest works very well. And your kids even have more money to receive someday. And again, it's growing. You can take it out for a special purchase you want to make. It's tax-free, doesn't put you in a new bracket, because you've made that conversion in a strategic way several years ago. And we kept you in a lower bracket. So all of those earnings then become tax-free. So it's wonderful. And it's kind of a strange little law, but like I said, there's no RMDs on a Roth, and that's fine. But there is a strange one. If you pass away and your kids inherit the Roth, you would think there's no RMD on it because it's all tax-free. So what's the difference? But there is. For some reason, Congress said if a non-spouse inherits a Roth IRA, they have to clean it out within 10 years. It doesn't increase taxes. It doesn't give the government more money, but it does put money in the market and makes it work in other places. So there is an RMD requirement for an inherited Roth account. Otherwise, there's not. And so it can be a very efficient tool to do that. The older you are, I'm 67, the older you are mathematically, it doesn't make quite as much sense, but certainly it's actually a break even. If you're going to live, if you're 65 and going to live 20 years, it works out breaking even that converting to Roth doesn't hurt you at all on taxes. And so part of the Roth conversion strategy has to do with emotions. And if you just know in your mind that your retirement money, all the tax has been paid on it, you never have to pay tax again on it, and that obligation is done, it just kind of a load off your mind, and it makes you feel good. Kind of like becoming debt-free. For those of you that have been blessed enough to actually pay off your last loan and be completely debt-free, it's a great feeling emotionally. So if you can get all your retirement assets eventually into a Roth, knowing that you never pay tax again on that money, that's a good feeling to have, and you're not bothered with RMDs, and it can be a very good strategy. So.
Hey, that's great, Brad. Thank you so much. I think even in just the answer to that question, it's very apparent all the various nuances in tax law, all the different ways that Roths work. We've talked about required minimum distribution and the different ages. We've talked about step up in basis and how that works on non-IRA money. We've talked about withdrawal requirements on inherited IRAs and the penalty associated with not taking out those required distributions. We've also talked about qualified charitable distributions and how that can benefit somebody's tax situation. So not to mention all the nuances of these various strategies, but these tax laws change on occasion. And so just in my mind, kind of solidifying the need for a great tax planner like yourself in their corner. So, well, that's all the time we have today. Thank you again for your time, Brad. I realize for those on the call that this is certainly a master class in some of the most significant tax planning strategies that you can do with your investments, but we may not have scratched your particular itch based on your particular situation. If that's the case, I want to encourage you to get in touch with Brad at his office. His phone number is listed on the page there, and his email is as well. We'll give you a quick second to take that down if you'd like. And if you'd like to discuss your personal situation from an investment perspective, we can incorporate Brad into the conversation as well. You'll see our office number there and an email to schedule some time. So I want to thank you again, Brad, and thank you everybody for joining us today. Look for us next month as we have a college planning webinar here at the beginning of September. So you guys have a great day. Bye-bye.